Let's jump right in. REG questions usually test whether you can identify the taxpayer, classify the issue, apply the correct rule, and determine the tax or legal impact. The goal here isn't to memorize every single tax number. The goal is to use a consistent decision framework under exam conditions. And just to put your mind at ease right up front, index tax limits, phase-outs, and exact tax rates, those will generally be provided to you on the exam when you actually need them. What you really need to understand is that the blueprint covers a massive amount of ground. We're talking tax practice rules, business law, property transactions, individual taxation, and entity taxation.
The REG question framework.
To successfully navigate all of that, you absolutely need these 6 steps. Why? Well, because wrong answers on the CPA exam usually don't happen just because you forgot a specific rule. They happen when you apply the right rule to the wrong taxpayer, the wrong entity, the wrong transaction type, or maybe at the wrong point in the tax return flow. This 6-step framework is designed to prevent those specific, highly tested errors.
Section 2. Identifying and classifying.
Step 1 is locking in the actor. And this is huge because the taxpayer or actor you identify often entirely dictates the rule you have to apply. On the tax side, ask yourself, are you looking at an individual, a C corporation, an S corp, a partnership, or maybe the tax preparer themselves? Think about it. If you apply an individual deduction rule to a C corp, you've already lost. On the business law side, are you dealing with a principal, an agent, a debtor, or a creditor? You have to identify the player before you play the game.
Once you have the actor locked in, we hit steps 2 and 3. Step 2 requires you to classify the issue. Is this an income inclusion, a deduction, a loss limitation, or a separately stated item? Then, step 3 asks, what does the rule actually do? Is the result taxable, deferred, or basis increasing? I really want to emphasize a core thesis here. Classifying the issue accurately is often far more important than the actual calculation. If you misclassify a non-deductible penalty as a deductible business expense, your math could be flawless, but your final answer will be completely wrong.
Section 3. Step 4. Applying flows.
First up is the individual tax flow. You need to map it strictly in this order. Start with gross income, minus exclusions and adjustments, which gets you to adjusted gross income, or AGI. Then you subtract deductions, either standard or itemized, plus any qualified business income deduction to reach taxable income. Only after all that do you calculate the tax and apply credits. Never ever try to use entity-level rules on this individual flow.
Now contrast that with the entity tax flow. For partnerships and S-corps, you generally start with book income. Then you make tax adjustments to arrive at ordinary business income. Crucially, you must pull out separately stated items, things like charitable contributions or capital gains, because they retain their character and pass directly through to the owners. This ultimately impacts owner basis and the owner-level tax. The classic trap here? Confusing book income with taxable income, or just forgetting to pass those separately stated items through to the owners entirely.
For property transactions, you want to pace yourself deliberately through this flow. First, calculate the amount realized. So, what you got, less any selling costs. Subtract the adjusted basis to find your realized gain or loss. But remember this, a realized gain doesn't always mean a recognized gain. You have to determine exactly how much of that gain is recognized on the tax return, check the character, like is it ordinary under Section 1245 or capital under Section 1231, and then finally determine the basis of the asset moving forward.
And finally, we have the business law flow. Whether you're dealing with contracts or agency, the progression is super logical. Was a valid relationship or contract formed? What authority, rights, or duties were established? Was there performance? Was there a breach or default? And lastly, what is the remedy or liability? You absolutely must identify the legal role at Step 2 before you even attempt to resolve a liability question down at Step 5.
Section 4. Basis, limits, and tasks.
You must constantly diagnose basis and limitations. This brings us to Step 5 of our framework. For basis, ask yourself, what is the starting basis? What specific items increase or decrease it? And what is the exam actually asking for? Are we looking for ending basis or the taxability of a distribution? On the flip side, for limitations, ask, are we dealing with an at-risk limitation, a passive activity limit, or maybe a capital loss limit? And is this limitation applied at the entity level or the owner level? Let me be crystal clear here. Never, ever ignore a taxpayer's basis before trying to take a loss. Next, Step 6 dictates your cognitive approach by identifying the task type.
If it's a recognition question, the exam just wants to know if a rule applies. If it's calculation, they need the exact amount. Simple enough. But if it's analysis, you're sorting through facts, exhibits, or source documents to reconcile data. And those task-based simulations, or TBSs, those are literally just several small, interconnected REG decisions combined into one larger problem.
Section 5. The framework in action.
Okay, let's put this mental scaffolding to the test. Here's our first scenario. Taylor, a sole proprietor, pays $6,000 for business office rent and $2,000 for personal life insurance. How are these items classified and flowed?
Let's apply the framework. Step 1. The taxpayer is an individual operating as a sole proprietor. Step 2. The issue here is classifying a business expense versus a personal expense. Moving to Step 3, the rule tells us business rent is an ordinary, necessary, and deductible expense, while personal life insurance premiums are strictly non-deductible. Finally, Step 4, the flow. The rent is a deduction for AGI reported on Schedule C, which lowers taxable income. The life insurance, it has zero tax impact. Notice how classifying the issue completely resolved the question before we even thought about reaching for a calculator?
Let's look at Scenario 2. Omega Corp sells a warehouse for $80,000. The original cost was $50,000, and $20,000 in straight-line depreciation was taken. So, what is the tax impact?
Following the framework again. Step 1. The taxpayer is a C Corp. Step 2. The issue is property gain and potential depreciation recapture. Step 4. The flow dictates we take the amount realized of $80,000 and subtract the adjusted basis. Well, the original cost of $50K minus $20K in depreciation gives us an adjusted basis of $30,000. So $80K minus $30K yields a $50,000 realized gain. Because it's a C Corp selling real property, Section 291 ordinary recapture rules will apply to a portion of that gain, with the rest flowing to Section 1231. Mapping that property flow step by step literally prevents you from mixing up the math. And our final scenario, Zeta S Corporation reports $150,000 of ordinary business income and $8,000 of tax-exempt interest. Shareholder Eli owns 100%. What is the exact impact on Eli?
Okay, Step 1. We actually have two taxpayers here, an S corporation and its 100% shareholder. Step 2. The issue is flow-through income and separately stated items. Step 3. The rule is that both items flow through to Eli. The ordinary income is taxable, but the tax-exempt interest retains its character and is not taxable to Eli. But here is the absolutely critical entity flow step. Eli reports the $150K as taxable income, but his stock basis increases by the full $158,000. You must increase basis for that tax-exempt interest even though it isn't taxable, otherwise you will completely fail the basis calculation.
Section 6. Traps and Takeaways.
The CPA blueprint is specifically designed to test if you know the difference between these concepts. Let's rapid-fire some of the exam's favorite traps and our framework fixes. Using individual rules for an entity, fixed by Step 1, always lock in the taxpayer first. Confusing book versus taxable income, fixed by Step 4, map the entity flow adjustments. Forgetting separately stated items, fixed by Step 2, classify the exact issue type immediately. Ignoring basis before taking a pass-through loss, fixed by Step 5, always check basis and limitations first. Mixing up a realized gain with a recognized gain, fixed by Step 4, map the exact property flow. And finally, trying to memorize obscure figures instead of applying the rule, fixed by Step 3, determine what the rule actually does.
REG questions become easier when the student uses the same framework every time. Identify the taxpayer or legal actor, classify the issue, determine what the rule does, apply the flow, check basis and limitations, and then calculate or conclude. So, the question I'll leave you with is this. Will you let the exam confuse you with endless variables, or will you take control by trusting the framework?